Investing in stocks and ETFs is a great way to get started in investing and in building your wealth. But once you've built up that foundation, it's time to look at something that might even be able to boost your profits way more. A very solid way to supercharge that wealth and diversify into a new asset class may be to jump into real estate investing. Most don't get into real estate investing because it seems crazy, or they've heard horror stories, or it's just flat out not possible to save up for that down payment. This video is going to give you 6 different ways that you can invest in real estate, ranging from much lower risk to higher risk, and how you can get started on less than $100, or how you can work on figuring out a way to get you to hundreds of thousands of dollars worth of profit. All of these ways are super nice ways that you're going to be able to build up your portfolio to increase that cash flow that might help you be able to retire early, live off of passive income forever. My name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. The first way to diversify your portfolio is actually going to be the cheapest and the easiest. REITs allow you to invest in real estate without the physical real estate. Often compared to mutual funds, they're companies that own commercial real estate such as office buildings, retail spaces, apartments, and hotels. REITs tend to pay high dividends, which makes them a common investment in retirement. Investors who don't need or want the regular income can automatically reinvest those dividends to grow their investment further. Management handles all of the ownership and rental logistics. You just sit back and collect dividends, which are frequently higher than many stock-based investments. I'll highlight 3 REITs that I really like now in 2024. And the first one is called Realty Income, or O. This is one of the best overall dividend investments that you could make, and I really like it specifically now in 2024. It has had 29 years of dividend increases and has boosted the dividend quarterly for 104 quarters in a row. The dividend's also paid monthly, and it's basically as close as you can get to replacing a paycheck via the stock market. Realty Income is more than twice the size of its next closest competitor in the net lease REIT niche. Try to say that 3 times fast. Realty Income owns around 15,000 properties following the recent closing of its acquisition of Pure Spirit Realty. It just operates at a level that its rivals can't even compete with. And this means that they get access to larger deals and they have more capital to work with. The next REIT I really like is called VICI, and that is a net lease REIT that specializes in buying and developing casino and gaming properties. Rather than operating the hotels and casinos themselves, the REIT leases them to big name operators in the industries such as Caesars, MGM Resorts, and the Venetian, making its money from rents over the long-term lease periods. It has a crazy solid dividend yield of 5.55%, and over the last year it's down about 11.5%, so this is a good time to snag some on sale before the Fed interest rates lower and the stock shoots right back up. The last one on this list is called AMT. American Tower owns cellular towers and data centers, the backbone of the mobile experience. Our world is only getting more and more technological, and the use of cell phones is a necessity for all every day, especially in global expansion, and AMT is the front runner. The stock's at a historical value since the Fed rates have made it hard to fight through the debt and growth. AMT is down about 9% year to date and has a nice dividend of 3.42%. I like this one more so because it's much different than most REITs, where it's not commercial or industrial buildings, but towers for technology that we definitely use every day and need. Now, individual REITs are cool, but what I like even more than that would be looking at a real estate ETF. Now, obviously, I am the ETF guy here on YouTube, and so I'm a little bit biased towards this one. But I really like this because just like in the regular ETF investing world, it's much less risk for an investor to go ahead and invest in an ETF versus an individual stock. Same thing happens with an individual REIT versus a real estate ETF. Much less risk, much higher diversification, and overall, it actually performs really, really well. So for this, I found 3 really, really solid real estate ETFs, and so I'm going to compare and contrast them a little bit to give you some numbers and things that you should focus on when making your selection. These are the Vanguard Real Estate ETF, VNQ, the Schwab US REIT ETF, SCHH, and Real Estate Select Sector SPDR Fund, XLRE. The first thing we're going to look at is the number of holdings, because the more holdings that an ETF has, the more diversified it is, and so it's not relying on any one piece for it to do well or for it to drop super hard. BNQ has the most holdings of the 3 ETFs with 166 total holdings, SCHH has 127 holdings, and XLRE has only 32 holdings. The next thing to keep in mind and consider is the expense ratio. BNQ has an expense ratio of 0.12%, which is higher than SCHH's 0.07% and XLRE's 0.10%. Another big thing to keep in mind is the 10-year return. We want to see how it's done not just in the last year, but over time. BNQ has an average 10-year return of 6.37%, SCHH has a 10-year return of 5.08%, and XLRE hasn't been around for 10 years, but it has a 9-year return of 6.55%. All 3 of these ETFs have their unique advantages and disadvantages. BNQ has the highest assets under management and the most holdings, making it a popular choice among investors looking for diversification. SCHH has the lowest expense ratio, making it an attractive option for cost-conscious investors. XLRE is the highest long-term return, indicating strong performance in the past. Now, the next couple ways to invest in real estate are the ones that actually move that needle immensely. And with these, I've personally seen over 6 figures of appreciation in less than 2 years. But first, a quick thank you to the sponsor of this video, Nextiva. If you own a business that relies on effective communication with clients through phone calls or text messaging to close deals, did you know that you could automate up to 90% of your interactions and eliminate 30% or more of your costs? And you can do all of this without having crazy tech experience. Even if you're running your entire business off of just your phone right now and your bookkeeping is just an Excel spreadsheet. I know that in my personal private finance coaching business, things used to get unorganized real quick, and it felt like I was barely keeping my head above water trying to make sure that things were in the right place. It makes your business level up quick if you have everything organized and if you can offer features that other businesses can't. Nextiva lets you create new phone numbers, gives you unlimited calling, texting, and an auto attendant that you can run from your phone or computer. You also get an AI-powered dashboard that will show you all conversations in one platform, including an AI voice and an AI chatbot that can interact with your clients for you. And then all you have to do is focus on closing and scaling. This is the year to level up your business, lower your costs, and take advantage of AI. Head over to trynextiva.com/ProfessorG or use the link down below in my description to try this out and get 50% off your plan. So these next couple ways all have to do with investing in actual physical real estate. Each one of these carries a bit of risk, just like investing does, but I'm going to list these in order of least risky to most risky, and in that same way you should expect that the least risky is probably going to have the least amount of return, and the highest risky might have the potential for the craziest, biggest amount of return. Now, most of the risk comes from the fact that it's usually a really big upfront cost when you're having to buy something huge like a house or some type of rental property. To buy a house, you can expect to put down at least 3%, but all the way up to 20% for a down payment. And so that could be the difference between about $10,000 to $200,000, depending on what it is that you're buying. And it could even be more than that if you're buying something huge. You'll definitely have things like closing costs and furnishing and insurance. There's a lot to it, but at the very least, that down payment is the first number that you're going to have to worry about. You'll definitely want to run the numbers and take the interest rate into account as well, because a mortgage on a $300,000 loan with a 3% rate comes out to roughly $1,265 per month, but that same mortgage on the same $300,000 loan with a 7% rate comes out to almost $2,000 per month. That could be all the difference between if that property cash flows or if you're even able to afford that mortgage overall. So when I talk about actual real estate as an investment, I'm not talking about your personal home that you live in. Like Robert Kiyosaki of Rich Dad Poor Dad says, an asset makes you money. A liability takes money from you. For your house that you live in, you pay a mortgage on that each month and it doesn't pay you anything. So for this section, we're talking about real estate that actually pays you money. The only way that you could get your actual home that you live in to be in this category is if you buy the house and then you rent out some of the rooms, so you're living in one of them and maybe you have a roommate in one or two of the other rooms, and they're paying you rent to live there. This is called house hacking, and it's incredibly smart for anyone to do if you can. I try to tell all my students to do this rather than rent an apartment if they can. If you can find a way to save up the down payment on a home and you can buy it, but then have 2 or 3 friends pay you each month to live there, this will pay down your mortgage and possibly make it so that you get to live there free. And then now, instead of you having to pay that on rent or mortgage each month, you could take that full amount and throw it into ETF investing and just double your wealth easy. Now, if you're looking to make a major commitment into real estate investing, this is where you can start considering buying rental properties. Rentals can offer steady cash flow as well as the possibility of appreciation over time, but they're one of the most labor-intensive methods of real estate investing. There are 2 different types here, and that would be the long-term style tenants and then short-term style rentals like Airbnb. And there's definitely pros and cons to both, and I've done both types of real estate investing. Pros are obviously the cash flow and the tax benefits. You get to write off certain taxes that you have to pay, and you get to depreciate the home on your tax sheet while it actually appreciates in real life. So it's like a double positive. Houses also appreciate at an average of 4 to 8% on average, depending on where you live, but sometimes it's way more. The cons definitely center around the idea that you have to find and vet tenants. You'll also have to pay for ongoing maintenance, take care of repairs, and deal with any other problems that arise. Dealing with people is very much a tough thing to do, especially when those people look to you to solve their problems as their landlord. You're likely gonna have to pay much more on a rental property as an investment property than you would have had to as a down payment on your regular house. To buy a regular home, you need to put down about 3%, but for rental properties, closer to 20%. And as far as those rental properties, like I was talking about before, there's 2 different types. The first type is the long-term style. These properties are generally designed to be rented for at least a year and in theory provide a steady monthly cash flow, though this depends on your tenants being reliable. You might buy a multi-unit property or a single-family home that you rent to others. I like this style the best because it kind of fits with the message of this whole channel, which is to keep investing simplified. This is a much simpler way to do it. You have to deal with it once, maybe twice a year, and you have long-term tenants that hopefully just keep paying every month and it all works out. This is going to build wealth slower, but slow and steady wins the race. Then there's short-term rentals. These properties cater to rotating tenants whose stays might be as short as 1 night, like Airbnb. You might list your entire home or apartment when you're away, or you could invest in a separate property meant only for short-term rentals. This style can definitely generate much more money much quicker, but also the problems can be much crazier. You're dealing with very short-term tenants. Think about the last time you went to an Airbnb. You're not caring for it as your own because you know that you're going to be leaving in a day or 2. Whereas if you have a longer-term tenant, they know they have to live in this mess if they make a mess, and so they're going to take care of it just a little bit more. If you're going to do short-term rentals, make sure that you learn everything that you can about it, and there's a lot of information about it here on YouTube. A management company can definitely streamline the process and make it easier, but they usually charge like 20%, which eats into your profits big time. The last one on this list is one that's very attractive for a lot of people, but it's also the highest risk by far. You could also make a good amount of money from it. And this one comes from flipping properties. You invest in an underpriced home in need of a little love, renovate it as inexpensively as possible, and then resell it for a profit. This strategy is definitely harder than it looks like on TV. It's also more expensive than it used to be given the current higher cost of building materials and mortgage interest rates. There's a huge element of risk here because it takes a lot of math trying to figure out exactly how much things are going to cost. You have to estimate this correctly, or else that's just going to eat at your profit big time. One big suggestion if you want to get started in this is to find an experienced partner. Maybe you have capital or time to contribute, but you find a contractor who's good at estimating expenses or managing the project. The other risk of flipping properties is that the longer that you hold the property, the more risk and the less amount that you're going to make overall because you're going to have to pay the mortgage each month, and that eats at any profit that you were going to get from selling it. You can lower the risk by living in the house as you fix it up, and most people do this strategy, especially at first, but then again, there's that emotional and psychological part of it where you're living in a house that you have to fix up, it might get to you. Real estate investing is one of the ways that you can build wealth the fastest, but also the longest term. It's one of my favorite ways to invest, but it's definitely not for everyone. Most times, stock market investing is much cheaper and much easier, so watch these videos on how to keep things simple and how to keep building that wealth for financial freedom.